All right, I've hit the button. We're ready.
Okay. Hey, everybody. Tom Deutsch here, key leader with Symmetry Financial Group. Welcome to the Debt-Free Life, the DFL overview and Q&A with senior analyst Scott Forehand. Just want to take a moment and introduce him. Scott has been with Symmetry over 2 years now. He is an agency manager, agency owner within the company. But most importantly, when Symmetry took on the Debt-Free Life project about a little over a year ago, Scott kind of embraced it. As a company, and these numbers have not been updated for September yet, but as a company, when the plans that we've put in place for our clients are fully executed, we will have retired more than $755 million in debt. Our clients will have saved more than $243 million in interest. And really what's kind of shocking is what happens to their retirements. On a whole, our clients' retirements will be improved to the tune of $2.18 billion. Now, just individually, Scott, I know you're up over 60 families now. Are you up over 70 families?
Probably.
Probably, okay. I know you're way over $35 million in debt elimination. And you've got to be well over 100 million in retirement improvement. But without any further ado, my friend and colleague and the person I look to when I'm asking questions about the Debt-Free Life Your Family Bank program, Scott Forehand.
Thank you, Tommy D. Hi, everybody. My name is Scott Forehand. I'm an agency owner here at Symmetry Financial Group. I am in the parlance of Symmetry. My coaches and mentors are Janet and George Matthews, and I'm very happy that that's the case. We're here to talk today about debt-free life and what it can do for you, both from an individual or, I guess, a primary user's perspective, but also from a business perspective and how you can be utilized in a business manner. Couple of things just to look up, just to give a brief overview. What debt-free life is, it is a play on words. It is using debt to get out of debt, and it's using life insurance as the vehicle to do so. And it's a critical kind of life insurance, which we'll talk about in depth in just a minute. So if you're here, you are either a client of mine, a client of one of our agents or brokers, or maybe you're someone who's just getting into the debt-free life swing of things, and you're here to learn. Regardless of why you're here, welcome. Some of the stuff we're going to talk about, we're going to try to keep it at least on the cursory level, relatively basic. We will talk about some things will be a little bit more in depth. You can ask any question that you want. We're a completely open book here, but sometimes the things that you ask may take longer than we have available time to explain. So some of those things we may have to say, we'll take that offline because we don't want to involve everybody's time, because I believe there's an advanced market training class after this. Anyway, so what this is, debt-free life, is designed to defeat the debt monster that we all are taught from the day we come into this business, that it's okay, not just business, but the day we come into this life, that it's okay to do that. We are taught from the day one that debt is not a bad thing. We're taught that it's okay to take on debt as long as you're making more money than you move through life. And we are taught really at every turn or every corner, we are I guess subconsciously taught that we should take on more debt. You should go out and get a car loan. You should take on credit cards to build your credit. You should use student loans if you need to get through college. You should borrow money to buy a house. You should borrow money to buy a wedding ring, or whatever the case may be. There's lots of different reasons why you may need money, but we always end up borrowing money, and we're taught that it's okay as long as you manage it. The problem with that is that most people are not good money managers, and most people get quickly into the situation where their debt runs their lives, and that's not what debt is supposed to be. So what we do, and what Symmetry said was, well, what if there's a better way to do it? What if there's a better way to spend money? What if there's a way that we can create an environment where if we need to borrow money, we can, but we're not borrowing money from a bank or from a mortgage company. We're borrowing money from ourselves. And that's what the debt-free life system is about. And that's how it works. So without further ado, let's get deeper into it. So the primary focus of debt-free life, obviously, is to get out of debt. Debt-free life works in 3 phases. The first phase is called the maximization phase. And what we're doing in that phase is we are maximizing the use of our dollars. We're spending the money the most efficient way possible. And in most cases, I have yet to run into anybody who is spending money in the most efficient way possible. So almost, well, I can't say everybody because I haven't met everybody, but everybody I've met is not spending it correctly. There's one thing or two things, or maybe everything they're doing wrong. So the primary focus of a debt-free life program, initially at least, is to get out of debt. Secondary program is to build retirement. And the third program, the third portion of this, the third goal in this, is to put yourself in a situation where you'll be able to take that retirement, not in a tax advantaged way like a 401 or a tax deferred way, but in the best possible taxed way, which is goose egg, no tax. That's the best way to take money out of your plans. So that's what we're going to show you how to do. So these are the 2 questions that when we take our training, these are the 2 questions we're taught to ask. And I like the first one. Are you 100% sure that you're going to have a great retirement? I haven't met anybody other than a couple of pompous financial advisors who have told me, yes, I'm 100% sure I'm going to have a great retirement. The other question, though, is a little bit suspect because there's a couple different ways you can look at it. What if I could show you a way to get out of debt in 9 years or less, including your mortgage, without you spending any money than you are today? The premise of that is accurate, but the reality is a little bit different. As I'm putting more and more of these programs in place for families, what I'm seeing is it's not 9 years or less. It's actually 15 to 27 years early. Okay. And that number is even more impressive. Even if it only gets you out of debt in 15 years, that's significant. And if you were going to be in debt for 30 years, that's 15 years of retirement that you can have running. So, as we move forward, one of the things I do want to mention about this is a Symmetry product. This is proprietary to Symmetry Financial Group. This product was not available in this country until June of 2019. So this is a relatively new product. The concept is not new. The concept's been around for 100 years, but this product was not available to the mass public, to the general blue-collar person until about a year ago. Let's talk about the average household. So this is you. This is me. This is the average person in the United States. We make good money. We spend money, and the majority of our money is spent on interest and taxes. Taxes, we don't really get anything in return except for the infrastructure and the other, there's politicized ways that you can look at the taxes. I'm not going to go there tonight. And the other thing that we do is we spend a lot of money on interest. We don't have to be spending the money on interest. So if I can save some money, if I can shave how much I spend in taxes, if I can shave how much I spend in interest, then that money, those savings, I can spend in those other 2 pieces, the savings, 3% up at the top, and the lifestyle. That's my monthly cash flow. That's me making all my payments and everything and whatever's left, maybe having enough to pay my Netflix bill. Okay. So the idea here is that we want to shave some money away from the interest that we're spending, shave some money on the taxes that we're spending, and create additional income or additional cash flow going towards our savings and going towards our lifestyle. So if this describes you like it probably does, like it describes me, then this is the average American individual. All right. So what I said a few minutes ago about how much money we make as Americans, we make a lot of money as Americans, and the average American makes about $2 million in their lifetime. And if you spend money correctly or money efficiently, $2 million is plenty of money to make in your lifetime and still have a solid retirement. The problem is that we spend too much money on taxes, we spend too much money on interest, we don't save enough money, and we don't have our regular cash flow set the way that it should be. So what does that mean? The average person who's making $2 million between the ages of 50 and 65 when they retire, those are the highest income earning years. But yet the average American at the end of their life, when they're ready to take that retirement, they only have about $60,000 in retirement. So if you're in that last 15-year span and you're earned 70, 80, $90,000, $100,000 a year, all of a sudden you're going to go drop down from $100,000 a year income to $60,000 for the rest of your life, relying on Social Security, maybe a pension, maybe an IRA, which is certainly not going to be performing anymore. Those things, those thoughts that we have, those plans that we made, unfortunately, the reality is somewhat different. And there's something that we can all do. And we can even do this up to age 70. Actually, I've done this for a 73-year-old. We can even fix this at age 73. So it's never too late if you're willing to take the steps that you have to do to get your retirement back on track, to get your debt under control, to maximize the return on your money, to spend your money the most efficient way possible. So how do we do that? Well, the first thing we got to do is we got to fix the traditional approach. What you're going to hear from money managers and debt consolidation, quote unquote, experts and those folks is they're going to tell you to work harder, get a second job, spend less money, go eat ramen, consolidate your debt, refinance your debt, take a home equity line of credit. I'm not going to mention his name, but there's a gentleman out there he's really heavy on using home equity lines of credits to help you get out of debt. Problem is with all those things is that it's still more of you. It's more of your time, more of your effort, less quality of food that you're putting in your body. Taking one bucket of debt and moving it into another bucket of debt. You're not eliminating the debt. You're not eliminating the problem. The only thing on there that you see on that right side of your screen that really does work is debt snowballing. And that's true debt snowballing, not debt stacking, but debt snowballing. So if we can do those things, fix the way you spend money, create a debt snowball, and decrease the interest that you're paying, decrease the taxes that you're paying, increase your lifestyle, your cash flow, your monthly cash flow, and most importantly, increase the amount that you're saving for retirement, then we can fix your future. And how do we do that? Well, it comes back to that one question: eliminate your debt in 9 years or less, right? So how do we do that? We simply change the way you spend money and change the way you think about money. So where we want to go from is we want to move you from that left side of the screen to the right side of the screen. If you eliminate your taxes, 10% of your taxes, go from a 40% down to a 30%, that's actually eliminating 25% of the taxes you're going to pay over time. That's going to be that's going to be income based, and that's the main place where we're going to recover some of those taxes. The interest moving from 34% down to 22%. If we cut 12% of the interest out of what you're paying over time, then that's not just a 12% reduction in interest. That's actually a 35% reduction in interest if you run the numbers. So right now, if we reduce the taxes you're paying by 25%, reduce the interest you're paying by 35%, then the rest of that money, assuming you're not going out and getting a new job or a second job or making more money, you're just making exactly the same amount of money that you're spending, that you're making right now, and spending the same amount of money that you're spending right now, then we're able to figure these numbers. We're able to increase your lifestyle from 23% of every dollar you make to 33%. We're able to increase the amount of money you're saving for the future from 3% to 15%. That's a 500% increase. That's huge. So if the average American is saving $60,000 for retirement, what happens if you put them up to $300,000? Okay. Moreover, $300,000, what kind of return are you getting on $300,000 versus 60, right? So that's income. The return that you get on that principal that you've got stored in your retirement account, that's income for you every year for the rest of your life, right? And that lifestyle, think about this for a second. So you know what your finances look like, and you know how much money you make. And you know at the end of the month, let's say at the end of the month, you have $1,000 left over from what you make. If we increase your lifestyle, that's a 43% increase. If we increase the amount that you have left over at the end of every month from $1,000 to $1,400, that's a $5,000 change per year without you going out and getting a new job, without you spending any more money than you're already spending, actually spending less. We're just talking about making your money work for you. instead of making you work for your money. Okay. So this is the richest people in the world have been doing this forever. And they know the whole idea here is that you want to put your money in a situation where it's working for you. And the only way you can do that is you have to eliminate those things that are drawing down on your potential, the interest that you're paying, the taxes that you're paying, those kinds of things. And you need to maximize the things that are going to work for you, which is your cash flow and your savings. So what we do is we're going to reduce the amount of interest. This is what we've been saying that you're going to pay to lenders. We're going to eliminate your debt in 9 years or less. I've seen it as fast as 2.3 years. I've seen it as slow as 16 years. It just depends on, everybody's different. We're going to improve your cash flow. And that's a critical piece here. Remember, we're not trying to create a new debt for you. We're not trying to create a new bill that you're paying every month. All we're trying to do is put you in a situation where you have the knowledge and the ability to spend your money more efficiently, right? If I can spend $1 and get $1 worth of goods, that's pretty efficient. But if I can spend $1 and only get 60 cents worth of goods, that's pretty inefficient. So that's what we're talking about. We're talking about spending your money better, more efficiently. Okay. So the 80-20 rule. There are other companies that are doing similar things that have come before us. There are other people that have made a living doing this and preaching this information to churches and anybody else who would listen to them. They've published lots of books. They've made lots of money talking about their plans and their systems. What we did at Symmetry is we took all of those previous plans that came before us, and we figured out where they all failed. And every one of them fails for some reason or another. And many of them have a lot of reasons why they fail. But we took every one of them, evaluated every one, figured out why each one of them has a potential to fail, and eliminated those potentials. And the biggest reason that we found was that most of those plans did not have an emergency fund built into it. We're not just saying, think about it and don't touch 20%. We're saying there's a separate fund. So the way our system works, there's going to be an emergency fund that you cannot see. You cannot easily touch it. We don't want you to. We want it to be used for a true emergency, not I need a new jet ski emergency, a true emergency. Okay. And that the money's there. You have access to it if you need it in an emergency, but otherwise you're not going to see it. And you're not going to have easy access to it. And that's a critical thing for what we do. So we've eliminated the number one reason why all those other plans fail over time. Next, we looked at retirement pieces. So all those other plans have some component of retirement. Some of them use home equity lines of credits as a vehicle. Some of them use 401ks. Some of them use Roth IRAs, and they're all adequate. But we're not trying to be adequate here. So if you have 10 different things that you can fix and you only fix 2 of them, then that means you're leaving 8 out in the open. Why don't you fix everything? So what we did was we looked at the different strategies and different vehicles that are available to people, and we looked at the one that's a tax-free strategy. Let's say that again. It's a tax-free strategy. So if you look at, and this is the comparison, this is a Roth IRA versus a traditional IRA versus a tax-free retirement plan. Same amount of money invested, same length of time invested, same interest rate, same tax rate when you pull the money out, if it's not a tax-exempt piece. The end result is for that $10,000 investment, the tax-free investment is hands down every time going to perform better than any of those other vehicles. So the old thought process of get a 401k, build it up, get the company match, let it grow over time. And eventually on the years that go up, there are going to be more years that go up than there are going to be years that go down. So eventually you're going to have a gain over time. And guess what? In the end, they're right. You make money. You make more money than you would have if you let your money sitting in a savings account. But what happened to that other money? Well, taxes ate a lot of it. And guess what? Whoever manages that retirement account ate a lot of it for you too. Because every time they make a change for your account, they're making money, potentially, if it's a managed account. Okay. So the point is our system doesn't use management. So there's no management fees. Our system, when you take money out, it's a tax exempt withdrawal. So you're never going to pay taxes on it. And when you put those two things, combine those two components of our system versus any other system that's on the planet right now, none of them can compare. So moving forward. This is what we talked about a few minutes ago. 3 primary phases of a debt-free life campaign. Maximization. This is where we're maximizing the efficiency of your dollars. We're using a debt snowball, true debt snowball, not debt stacking. We're using a debt snowball in conjunction with you being disciplined and following a plan where you're going to take the money, put it into your bank, leave it in your bank until you need it, pull it out when you need it, pay off a debt. Once the debt's paid off, whatever you were paying on that debt previously comes back up into the bank. So now you're repaying yourself. You took a loan from yourself, repay your loan. And as you're repaying your loan, the cash value of your plan grows and grows and grows, which means the guaranteed interest applied to your account grows and grows and grows, which means the dividend that's applied to your account grows and grows and grows. Next, after we've paid off all your debt, we enter the accumulation phase. And this is where you've got some freedom. Do you have to continue funding your account at the level that you were? No. What happens if you don't? You don't get the gain at the end. So it's that simple. So if you want what the system will show you, which is a massive retirement, then you need to follow the plan. If you want just to get out of debt free, then you follow the maximization plan. It's up to you. You have complete control. Distribution. That's when we start taking the fruits of our activities. Everything that we've done, following the plan, doing the discipline, repaying our debt to ourselves, growing that nest egg. Now it's time to take that emergency jet ski, that emergency trip to the Bahamas, that emergency trip to the Grand Canyon. It's your money. Do what you want to do with it. Just take it in a tax-free manner. Now, I mentioned to you earlier that this is not a new concept. This has been done for a long time. And these are some people that have done it or are still doing it today. Walt Disney did it when he built Disney World. He used this. He had about $10 million. He did not have enough to fund Disney World by himself. But he had some friends that were in the insurance industry. So he went to his friends. They created a very specific and unique type of insurance product where they were going to pay him a higher interest rate than they were going to charge him to borrow against his deposit. So he put $10 million into his bank, pulled out $10 million, and the $10 million that was in his bank kept growing, kept getting paid an interest rate higher than what he was being charged for the loan, kept growing a cash value. Doris Christopher did the same thing with Pampered Chef. Ray Kroc did it with, I think, 30 of his original McDonald's locations. And then Warren Buffett does it to this day with Berkshire. So these are the smartest people in the world financially in the last 100 years that have used this concept and this theory. The problem is this wasn't available to the blue collar people because you had to have a big chunk of change to be able to negotiate with the insurance company to pay you a large return, a larger return than what they were going to charge you to borrow money against what you had on deposit with them. So thank you, Symmetry. And thank you for the other groups that came before us and figured out there was a way to do this and figuring out the ways not to do it and showing us by their failures. So at the end of this process, what are we doing? And it's what we've been talking about for the last 15 minutes or so. We're going to allow you to redirect inefficiently spent dollars. We're going to create efficiency in the way you spend money. We're going to allow the cash that you put into the system to grow, whether you're using money that's loaned against that value or not. And that next line is explaining what I'm talking about. We're going to borrow money from the cash value of the plan. So people, this is a hard concept for a lot of people. They say, well, wait a minute, if I borrow money, then I have less money. No, you're not borrowing the principal of the plan. You're never touching the principal. So the principal is already always in there and it's always growing. And the guaranteed cash growth that you get is guaranteed regardless of whether you've got a loan out against the policy or not. The only thing that loan affects is going to affect your dividend, which is another one of the repayment components of our plan. Pay off your debt 9 years or less, really 15 to 27 years early. Repay loans into the policy with freed up cash. So as you go through this process, you take a loan and you pay off a credit card. And that credit card, let's say it was $500 a month. So now that $500 a month that you're not spending on that credit card anymore, now you start paying yourself back. That money goes back up into your plan. What's it doing? It's either paying off the loan or it's building more loan capacity so that you can get to that next bigger debt and then that next bigger debt. And eventually all your debts are gone. Now, what happens after you're done? What happens after everything's paid off? Well, then you're in the accumulation phase, or maybe you couple this with some other concepts like annuities, and you start buying annuities and stacking your annuities so that you've got additional income coming from your annuities. Or maybe you go out and buy investment properties with this. I've got people that use these things. They're house flippers. So if they know that they're going to spend $50,000 for the house and they know it's going to cost $70,000 for renovation, then they will dump $120,000 into one of these plans and immediately pull the money out and go flip the house. And in the process of doing that, they've got that $120,000 working for them in perpetuity because they never pull the principal out. And then they sell the house, pay off the loan, do it again, do it again, do it again. So that's a great way to use this for business. And then the legacy. This plan, these cash values and the death benefit values for these plans grows so quickly and so large that it's almost impossible not to leave a legacy for your family. And in many cases, I'm not talking about your daughter. I'm not even talking about your grandkids. I'm talking about your great grandkids or your great great grandkids. If you structure these correctly, you can create generational wealth. So Symmetry's been doing this for a little while, just over a year. And when this original presentation was made about 8 months ago, those were a few of the folks that we had helped. $73,000 in debt, 84,000, 100,000. What I'm seeing is those numbers are nothing. Most of the people that I know, even if you've only got like a $200,000 mortgage, your debt is not $200,000. It's closer to 500,000 once you look at the different components of what true debt is. So, and the same process is what we've been doing is what we're doing now. Spend money more efficiently, increase your cash flow, decrease the amount you're paying in tax, decrease the amount you're paying in interest, pay off your debt 9 years or less. Get that tax exempt income, which is the most tax favored income of all types of taxed income. So how does this thing work? Let's look at you first. How do you spend money? So the first thing that happens is you make money just like anybody else does, whether you're a 1099, W-2, W-4, own your own business, doesn't really matter. You make money, you deposit that money into your bank, whether it's a Wells Fargo, Citibank, Bank of America, whatever, it doesn't matter. And then you spend that money because you have a loan, and as your money is sitting in your bank, that bank, just as a point of order, that bank is making money with your money every night. Every night they lend out your money at the federal funds rate, and they make anywhere from 1% to 24% with your money. And if they're really, really nice, sometimes they'll say, yeah, you've got enough money on deposit with us that we're not going to charge you to keep your money in our bank while they're using your money. And on a very, very rare occasion, they'll actually give you some portion of that, maybe 0.25%, right? And in the end, what happens? In the end, you have that, they're making money with your money every night, not paying you any of it, and then you have to pay a debt. And in the process of paying your debt, your money has become their money. Your money is gone forever. And what are you left holding? And the answer is nothing. Your debt's paid off. If it's a mortgage, then maybe you've got some more equity. But the end result is the bank made money with your money, didn't give you any of it, maybe made a nice thing and didn't charge you a fee to keep your money in their bank. But ultimately, you've got nothing left to show for it other than a debt that's paid. So let's look at our system. This is the debt-free life method. Same thing happens. You're working, not making more money, making the same money, doing the same job. Nothing changes there. You're still depositing your money into your bank, but here's where it changes. Instead of allowing your money to sit in your bank account and letting that bank to use your money over and over and over again, what we're going to do is we're going to move that money up into a debt-free life bank in the form of a whole life insurance policy. Why whole life? Because this is a specific kind of whole life policy. It's called a participating whole life policy, which means you get to participate with the profits of the company, the carrier that's offering you the whole life policy. So whole life is permanent. Whole life allows you to store cash, grows cash value. That's the basic part of this plan. We're using a whole life insurance policy. We're not using a 401k. We're not using any kind of IRS governed taxable retirement vehicle. We're using a whole life insurance policy, which is exempt from IRS regulation. The second thing we're doing, we're making one payment. It's one policy, but it's got a couple of riders. These riders are critically important. So the whole life is the base policy. The term life, that's a rider. And the reason why we have a term life rider is because there are some IRS tax codes that apply to what we're trying to do here. And one of the IRS tax codes, which is the reason why we like life insurance for this, says any monies derived from a life insurance policy are tax exempt. We like that. The other part of the IRS code that says this is IRS tax code 7702 for you campers out there. The other part says if the cash value of a life insurance policy exceeds the life insurance value, then that life insurance policy is not a life insurance policy. It's called a modified endowment contract, or MEC. And at that point, the game's over. At that point, all the money that you were going to take, tax exempt, it's now all taxable, and you lose. Okay. So, and there's a few instances where you'd want it to MEC, but only when you're older. And right now you don't want it to MEC. So for what we do, for the way we structure these, we always try to structure these, we always structure these so that the plan will not MEC. So those first two components of your single policy, the whole life policy, you got the whole life and the term life rider, that encompasses somewhere between 30 and 38% of your premium. The balance of your premium is paid up into what's called a paid up addition. So a paid up addition is a unique type of life insurance, and it is exactly the way it reads. It is paid up. So as soon as you pay for that paid up addition, the value is set. So if you paid $1,000 for that paid up addition, it's worth $1,000. But more importantly, how much is it worth tomorrow? It's worth $1,000. How much is it worth a year from now? $1,000. How much is it worth when you die? $1,000. So what we just did is we created a permanent asset, and banks, insurance companies, hedge funds, they all know that that's an asset, and that's actually classified as a tier 1 asset in banking parlance. And what that means is it is the safest, most secure type of asset on the planet. It's safer than gold because it's never going to fluctuate in value. It's safer than bearer bonds because it can't be lost. It's safer than any type of investment in the stock market because we're not going to have that oscillation. It is level. I know exactly how much it's going to cost. I pay for it. I know exactly how much it's going to be worth forever, and I don't have to spend any money to maintain its wealth. Gold, I've got to store. Silver, I've got to store. If I'm not taking it out as gold or physical gold or silver, then that means I'm having to have somebody watch it and store it for me, right? So there's all those things associated with every type of investment except for this. It is a permanent asset that will never lose value. So because of that, the carriers like it. Okay, so the carriers like paid up additions because what I'm doing is I'm giving them $1,000. They get to use my money for as long as they want, do whatever they want to do with it until I die, and then they're going to pay that $1,000 back to whomever I list as my beneficiary. So that's a critical piece of this whole conversation, in that they know that they're going to use it, they know they're going to make money with it, and they're going to pay us to use it. So this is where our bank differs from Wells Fargo or Bank of America or Chase. I am going to be paid for the use of my money, and I'm going to be paid a pretty hefty fee. The minimum fee is going to be 4%. Okay. So finally, looking at this, as I make this payment, my single life insurance payment up into my whole life policy with those two riders, what have I done? I've moved that circle of reusing my money every night up into my bank. And I'm now making money with my money, and I'm making money at the rate with the carrier that I typically use called Mutual Trust. It's a 4% guaranteed return, compounded monthly. So I'm making money with my money monthly. I won't see it until the end of the year, but I'm making money with it now. And the bank isn't using my money anymore and not paying me to use my money. Okay. So let's move on to the next step in this process. So I've got my money, it's sitting up in my bank. I've got some built up cash value in my paid up addition part. And all of a sudden, my bank capacity is at $2,000 because it's been going up every month, every time I make a premium payment. But my first credit card is now down to 1,600. So I've got more money in my bank than I have that I owe on my credit card, the first one that's on my schedule to pay off. So what do? I tell my carrier that I want to take a loan against my bank, and I take that carrier loan, deposit it into my checking account. And then I take the money from my checking account, tell my bank to pay my debt. And now my debt is paid off. So in the previous example, your money became their money. In this example, the carrier's money became their money. Your money is still sitting in your DFL bank, earning a pretty hefty return, guaranteed return, plus a dividend every year. So biggest question I get at this point is, what happens when I take that loan? Don't I have to pay the loan back? That's up to you. So the way these plans are structured, there is a dividend that gets paid annually. In the first year, it's not much to speak of. It really doesn't pick up size until you get into the second or third year. But the reality is that dividend will eventually become large enough, and I'm going to show you an illustration of that in just a second. It's going to become large enough that it will pay off your debt, whatever you've borrowed. So I ran an illustration earlier this morning. The family had about $240,000 worth of debt. With their plan, they're going to spend $110,000 to pay off $240,000 worth of debt, just through the course of taking a loan and letting the loan get paid off, and taking a loan and letting the loan get paid off. And then they're going to be out of debt in about 8 years. So it is not difficult to do. The concepts can be a little bit screwy sometimes, but this is how the plan works. So let's look at an example. So this is a standard family. This is a family that I helped last October, and they had it's a blended family. Husband and wife had previously been married before, so there were two properties that came into this. That's the personal residence and the other property. The wife is a doctoral student, so she's got a lot of student loans out there, about $108,000, $109,000 worth of loans. They've got a lot of credit cards. They've got some old taxes that they still owe because the husband is he's a 1099 and got behind on his taxes. So this is where they were. Because of the nature of their student loan, it was going to be 40 years for them to pay off their debt. What was their debt? Their basic debt, if they had the ability to write a check for $585,000, they could get out of debt in one day. But because of the way this is set up, with the interest over time, they're going to end up paying back $767,000 if they stay on their current track. So what did we do for them? We got them out of debt in 7.8 years. So I want you to understand what I just said. We didn't do anything. We didn't create an additional bill for them. We did not create an additional debt. All we did was change the way they were spending money, so that we changed the way that the money was flowing into a really inefficient manner into the most efficient way. And so this is where I said earlier, everybody's different. There is no one way fits every person out there. Everybody's debt's different. Everybody's income's different. Everybody's goals are different. But this is with our software, and the software is where the magic is really. The software tells us the most efficient way to pay off these debts, the order that they're going to be paid off. It computes how much interest we're going to pay over time, how much we're going to save, when we're going to get out of debt. So if you look at this plan for them, they paid off two of their debts in the first month. In the second month, they paid off another debt. Third month, they paid off another debt. Fourth month, they paid off another debt. Sixth month, they paid off another debt. Eighth month, they paid off another debt. 11th month, they paid off another debt. So in their first year of this plan, they paid off 9 of their debts. So one of the things I always say about these plans, it's not how much you owe that's critical. It's the number of debts that you owe that's really critical. The more debts you have, the better the plan will work. So when I talk to people, it's like, yeah, I was going to take out a new credit card, but I really don't want to. Take it out. Go for it. We're not worried about credit here, because the truth of the matter is, after you execute one of these plans, credit becomes irrelevant. You won't ever have to go to the bank to borrow money again. Actually, what will happen is your credit score will shoot through the roof. You'll have over 800 within 3 years. And then the banks are going to fall all over themselves trying to give you a loan, right? And just don't take it. Take the loan from yourself. Pay yourself. Don't pay them. So in this plan, 7.8 years. So we saved this particular family 31.2 years of debt. So in the end, the end result is the same. They don't have any debt, but now they don't have any debt in 7.8 years, which means they can really focus on the retirement. So how did this plan work for them? What would this plan have cost them if to not do this plan? So we saved them $70,000 in interest. That's not bad. I'll take $70,000 any day of the week. We cut out 31.2 years of payments. That's awesome. But more importantly, in 40 years, and they are 35 years old. So that's 75 years old. In 40 years, if they run this all the way through, they'll have $4.8 million in cash. So when I ask them, how much does this cost them not to do this? Well, if you're looking at a 40-year run, it's going to cost you $4.8 million not to say yes. But more importantly, if you want to call it a cherry on top, it also created $5.9 million of total assets. That's the cash plus the death benefit. Here's how it worked. Every one of these highlighted rows is a year in which they paid off at least one debt. So over the course of over 8 years, they paid off all their debts, which was like 16 debts. That last debt is one of the homes. This second debt is another one of the homes. So when I'm looking at this, I'm looking at the annual liquidity. So in the end of the first year, this family had $12,000 sitting in their account. That's on top of the almost $15,000 of debt they paid off, right? But the cool thing is that $12,000 plus that $14,000, that's still sitting in their account earning interest. Guaranteed compounded interest. So moving forward in their timeline here, on the fourth year, there isn't enough money in their program to pay off the large debt. The large debt was the next largest debt was $96,000. So they only had $91,000 in their plan. So they waited 2 months into the next year, and then boom, they're paying that off. And by the end of the year, they were back up to $61,000. A couple other key things to look at here. This plan was structured so that they could retire whenever they wanted to. So the gentleman that this was written on is 35 years old, like I said earlier. What if he wants to retire at 50? I could retire at age 50 with $842,000 in the bank. Yeah. So the interest on $842,000, by the way, folks, is, what's the next year? About 120. 120,000. So he's making $120,000 a year without even getting out of bed. That's not true. 32,000 contributed. He's making $90,000 a year just interest on the plan. Okay, that's the effect of compound interest, especially when you couple it with a dividend. So look at this. He's borrowed money to pay off all that debt. He paid off $585,000 worth of debt, right? He's borrowed the money from his private bank to do that. And then he's snowballed the money back in to pay himself back. Within 2 years of paying that last house off, there's no debt. The loan's completely paid. And that's paid back through just a combination of his monthly contribution plus the dividend that he gets annually, plus the 4% compounded growth. So if this gentleman wanted to retire at 50, he'll retire with $842,000 in the bank. If he wanted to wait 5 years, retire at 55, it's $1.5 million. You guys should be having a holy cow moment right now. All right. So let's move on to the next example. So the next example is a student. So one of the things we look at here, the debt is debt. It doesn't matter whether it's a mortgage or a car loan or a student loan. Debt is debt. And debt, especially student loans, are evil, and they will eat you alive later on. So right now we've got a little bit of a respite because they're not allowing them to charge us interest rates on our student loans while COVID's going on. But still, they're evil, and if you let them go, they'll run your life for the rest of your life. So this is an example of one that I also did back in October. This was a 23-year-old college student working on her master's. So she had, at 23 years old, $85,000 worth of debt already built up. That's a car loan, some medical bills, and student loans. That's crazy. $85,000, 23 years old. That's nuts. So more importantly, look at this. She has $85,000 that she owes, but she's going to pay $91,000 in interest. That's the effect of compound interest in a negative manner, folks. So what's her true debt? $177,000. How long? 40 years, student loans. So will she pay it off? Yes. But there's some assumptions that we make. When I run these illustrations and when your agent or broker runs these for you, we're going to make an assumption that you're never going to make more money than you're making now. You're never going to get a raise. Where you're never going to be able to pay more than what you're paying now. And that's the assumption we're going to make when we structure these plans. But we know that's not the case. So one of the other things we have to do is you have to build in some space so you can put more money into it if you want. So in this scenario, this girl worked as a waitress, part-time waitress. This plan was $350 a month. So it's about the same as her car payment, and a little bit more than a car payment. Car payment was $245. So in this scenario, rather than taking 40 years to get out of debt, she's taking 9.7 years to get out of debt. So we saved her 30 years of interest payments, 30 years of premium payments, paid off all of her debts. What does it cost her not to do this? So we saved her $64,000 in interest. That's good. It's a lot. But when she is 63 years old and ready to retire, if she had gone her current route, she would have zero to show for it. Going this route, she'll have $603,000 sitting in an account. And that's assuming she never gets a raise, never puts in more money than she's putting in right now. Here's how it worked for her. Every one of these years is we're paying off some debt, whether it's a student loan or a car loan or interest on a vet bill, whatever. She told me she wanted to retire at 65. I said, nah, we're going to get you retired at 55. So at 55 years old, if she never wants to pay into this plan again, she doesn't have to. And she'll have $409,000 a year. And the plan at that point is growing $22,000 a year. So she will have all of her debt paid off. She will have over $400,000 in the bank, and she will be growing that at $22,000 a year, tax-free. That's the equivalent, folks, of a $32,000 or $35,000 a year income, taxed. And she doesn't have to wait for the IRS to tell her, you're 62, you can take it now. That's another one of the beautiful things about this. The IRS doesn't have any control over it. Okay, so that's the end of the basic illustration. You need to take some time, talk with whoever got you here today. If you're here to get some training, talk with whoever your mentor, your coach is, and get involved in this. This is the hottest thing in the industry right now. It's far superior to debt consolidation. It's far superior to credit counseling because we don't care about credit. We're not going to hurt credit, but we are going to eliminate debt, which is going to do nothing but shoot credit scores through the roof. All right, so let me go ahead and stop that for a second. Where are we at, Tom? We got a little bit of time. So I can do the mortgage chunking piece.
I don't see any questions in the chat. So
yeah, I don't either.
You want to talk about mortgage chunking quickly?
Yep, I'm going to go ahead and do that right now.
While you're doing that, I got a quick question for you about that last chart that you went over.
Sure.
Remember we talked about the savings account where overflow money has to go because we don't want it to mech?
Yep.
You said that doesn't necessarily have to be another bank account. That can be a CD or a money market. It's illustrated at 2%, right?
Correct.
So if we set that up actually as a second year family bank account,
yep,
that's set up for someone's retirement, it actually would happen faster, wouldn't it?
Yep. So
okay.
we call that a pre-bank.
Okay.
Yep.
Gotcha.
So all that is it's just it's a term policy written with the same carrier on another member of the family. Okay. And then as soon as that the first bank fills up to capacity, then you simply modify that term. You convert it is the term. We convert the term policy to one of these participating whole life policies, and then you're off to the races.
Okay. And one question for you before you get into the mortgage chunking.
Sure.
I had to take a call during your presentation, so if you covered these two things, actually, I apologize for missing it. But number one, you had in one of the previous ones, you had talked about how the money is safe from having other hands laid on
yep.
it. And, and the second thing was someone who has no debt and wants to just never get into debt again and starting one of these things with no debt.
Right.
Did you address either of those? Did I miss that?
No. So let's talk about that real quick. So this plan, because it's a life insurance contract, it exists under the auspices of contract law, which means it's exempt from IRS tax code until you MEC. Okay. So IRS is watching, they're looking to see, but they can't touch it, can't make you do anything with it, can't tax it. A federal judge, state judge, local judge can't order you to liquidate it. It is a life insurance policy. At its core, that's what it is. So even though the cash value of that life insurance policy in the form of the PUAs is still a life insurance policy. So we have that protection built in. But one of the other things, if you read between the lines, this is a critical piece. One of the other things is that it is a life insurance policy that cannot be touched by a lawsuit. It's tort proof. Okay. So what does that mean? That means if I see Andrea Knopper there, Andrea, if I see you wearing a pink sweater and pink's my least favorite color and I want to sue you because you've hurt my eyes, I can file that lawsuit. But I cannot list a life insurance policy as a potential asset for you to satisfy the lawsuit. Okay. So it cannot be used as a solution to pay out a life insurance. Now you may want to, if you know, that's a decision you make, but nobody can force you to do it. So it's tort proof, it's IRS proof, it's tax exempt. And more importantly, when you compare this to like a 401k or a 403 or a 457, you're not limited by the IRS code as to when you can take it, right? So I don't have to wait until I retire to touch the money. I don't have to wait until I turn 59 and a half to move the money. I don't. It's my money. I do whatever I want to do with it whenever I want to take it. So one of those biggest questions I get is, what happens? Why don't I have to pay the loan back? And why am I not being taxed on the money I'm pulling out? And it's very simple. When you took the loan to buy your house, did you pay tax on the loan? When you took the loan to buy your car, did you pay tax on that loan? When you used your credit card, you may have paid sales tax, but did you pay an additional tax to use the cash from the credit card? That's a loan. And the answer is no. So that's why when we structure these vehicles, we're always going to take the money out of these plans as a loan, which makes it tax exempt forever. Okay. All right. So those are the two things that you just talked about, Tom, right?
Well, the second one was somebody who wasn't in debt currently.
Gotcha.
And wanted to set this up so they never got into debt.
So let's look at that scenario real quick. Okay, Tom, you're a used car salesman, and I just walked into your used car salesman's lot, and you've got a car that's out there with a $20,000 price tag on it. And I walk up to you and say, I like that car. I want that car. I'll give you $15,000. Oh, no, $15,000. I'll give you $15,000 cash. What's going to happen? You're going to in the back, you're going to talk to your manager, come out with paperwork, and I'm going to buy the car for $15,000. That's the rule, the golden rule. The person with the gold makes the rules, right? So when you start one of these banks, even with zero debt, you start one of these banks, start one of these plans, then what you're doing is you're storing cash for future, whether it's you're going to use it at retirement, or whether you're going to use it to go out and buy that car, create a loan for yourself, a 0% or 1% or whatever you want to charge yourself interest loan, and come back into it and pay yourself back, whatever. But the point is it gives you freedom, and it gives you freedom to do whatever you want to do with the money. That's the double-edged sword, Tom. Freedom to do whatever you want to do. So that's when that emergency jet ski can come up, and you got to be careful. Okay.
Thank you, Scott.
Yeah, man. All right, so let me do this next thing.
Hey, Scott, you got a couple questions in the chat.
Okay, I'll get to them in just a second.
Sure thing.
Hello, Mr. Satterfield.
Hello.
Oh, Tyler. Hey, Tyler. Build cash value and have a place to centralize their money. Absolutely. That means that when there's 3 phases in this plan. It's got maximization, accumulation, and distribution. So if they don't have any debt, then really what they're doing is they're starting off in the accumulation phase, which is fine. There won't be any debt snowball to make it grow quickly until they actually start using the plan. And when they start using it, then they can use this like, I'm going to go buy that car. I'm going to take $20,000. I'm going to go buy the car, and I'm going to charge myself 1% interest on this loan and pay myself back until I've paid back the loan. The cool thing about that is I'm probably not going to repossess my car if I miss a payment, right? And the other cool thing about this is I'm not going to send myself nasty grams if I stop making payments or if I miss a payment. And Jamie Satterfield wants to do anything to irk me. Oh, baby bird. All right. All right. So let's do this last piece here. This is mortgage chunking. So mortgage chunking, we're talking about, and we're using a mortgage as an example here, but the reality is chunking can be done on any debt, right? So if you've got a $20,000 credit card, you can wait until you have enough money to pay off the $20,000 credit card, or you can pay it off in $5,000 chunks. Same concept. The whole idea here is anytime you're paying a chunk of a debt down, you're going to eliminate the forward interest. Okay. So I'm using the example of that family that was in the previous presentation, which is it's the family with the multiple homes and the $767,000 of true debt, right? So using this family as an example, their mortgage, just so we're on the same page, is $215,000. Okay, so this is a standard mortgage depending on where you live. So $215,000. So how do I do that with mortgage chunking? So we're going to assume that we have a $215,000 30-year mortgage. We're going to assume that we also have other basic debts where we're going to get the some snowball from basic debt. And then we're also going to assume that the snowball is going to generate about $10,000 per year after the snowball is completely filled, meaning we've done everything, paid off all of our debts, and we're down to the point where the only debt we have left is our mortgage. So the snowball from those other debts is going to be $833 a month. And this is not abnormal. This is very common. So how does mortgage chunking work? So it starts with the amortization schedule. Oh, by the way, for all of you folks that are out there and you have a mortgage, did you look at your amortization schedule? Did you see how much your first payment was principal and how much of it was interest? And did you actually notice that nowhere in that amortization schedule until the very last year of your 30-year mortgage are you actually paying the interest rate they quoted you? Just an aside, okay? So this is a number I've seen over and over. It's around 74, 75%. Your very first payment is almost always 74, 75% interest on your standard amortization table with even a 2% interest rate. So, so looking at this, how does chunking work? So on day one, when we start our mortgage, let's assume it was May 2020, we owe $214,712. Okay? So we said 2.3 years. So we go 2.3 years in the future, we've got our debt paid off with the exception of our mortgage. So now we're in 2023, May. We've paid our debt down to $203,000 and we have $10,000 sitting in our private bank to do a mortgage chunk with. So what does that mean? That means I'm going to send the carrier or the lender a single check for $10,000. I'm going to mark it principal payment, immediate principal payment, so they don't apply it to future payments. And that's going to put the amount of money that I owe down from $203,000 to $193,000. But what else is happening? Take a look at that middle column, $332. That's how much my regular mortgage payments are paying towards principal. And I'm paying $807 towards interest, okay? So I make that single $10,000 payment. I get it paid down to $193,000. What happened? We are now paying $372 per payment is going to be principal. So two things are happening here. The first thing is I paid off a ton of principal. That principal is the equivalent of, look where we are in the amortization schedule. We're now in 2025. We have escalated through our amortization schedule 3.3 years. So with one single $10,000 payment, I essentially paid off 3.3 years of mortgage payments. Okay. And if I look at how much that would have been, it would have been $27,000 based on this mortgage. So for $10,000, I paid off $27,000 with a mortgage. But more importantly, I've made every single mortgage payment I make from now until the mortgage is paid off more efficient. And look, the efficiency is growing every month. So now in October, I'm paying $372. In November, I'm paying $374. The mortgage payment isn't changing, but the amount that's being processed and paid towards my principal is going up every month, which means I've made my mortgage payments more efficient. So a mortgage chunking plan like this is going to increase the speed at which you pay off your mortgage by somewhere between 10 and 12% faster than what it shows you on the debt management analysis form. Okay. And so at the end, what happens is we get our mortgage paid off significantly faster, and we are in a situation where we don't have to worry about whether or not anybody's going to foreclose on us, and we're really making our way through our mortgage. So what happens if we don't get all the way to the end? Go refinance for another 30 years, and then stop. You know, you're paying $1,100 a month at that time. Maybe now you're paying $1,200 or $300 a month on a new mortgage. I don't know, but it gives you freedom. That's the point. It gives you the opportunity to do things that you wouldn't normally have to do. And again, we're doing this without increasing how much money we're spending. All we're doing is changing the way you spend money. If you've got a credit card that you're paying $1,200 a month for, and the minimum payment is $600, you're just trying to pay it off fast, stop. Pay the $600, pay the minimum. Put that other $600 towards your bank. Let that be the fuel for your bank engine, and then use that money over and over and over again to pay all your debts. All right. So that's mortgage chunking. We are just about out of time. I don't see any of the questions in chat. So if you have a question, unmute yourself and ask. Come on, Nancy.
You did such a good job. I don't have any questions.
Okay. All right, baby bird. Where do you go?
Well done, Forehand.
Thanks, man.
He's hiding the pink shirt he's wearing.
Yeah.
Because he doesn't want to get a lawsuit.
He's into pink. There you go.
Yeah. Good job, Scott. Appreciate it. That was really good.
All right, Tyler. All right, so there's a number of these that have been recorded. Hello, Derek. Oh man, you're a Saints fan, huh? So sorry. Right. All right. So here's the deal. There's a number of these that are up on YouTube. You can check it out. Just Google my name, Scott Forehand, and the words Debt Free Life. There's also some business focused ones that are up there. So if you're looking at this from a business perspective, we've got business case studies that we've done. You can certainly contact me directly if you like. Just look me up or talk to whoever invited you here. I'll be happy to help them if there's a plan that you need to get processed for whatever you're trying to do. So at that point, I'm going to say thank you, everybody, for coming. We've got, Jamie McCrae. I'm going to go ahead and stop the recording.